That's Closing Bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. We are joined now by Jared Blookery to get you up to speed on the action from today's trade. Let's see where the major averages ended up. We had some kind of seesawing here today. Let's see. Look at the popular averages. The Dow does finish down. It looks like about 170 points. Your broad gauge, the S&P 500, finishes down about 0.2%. Your tech-heavy NASDAQ is basically flat on the day, as are the small caps, the Russell 2000. Just a quick look at the bond market. The 10-year, your benchmark 10-year, holds pretty much steady here at 4.34. Now to Jared for a closer look at today's sector action. Jared.
Thank you, Josh. Really quiet day here, kind of a reprieve in the markets. This is a chart of the Dow. You can see started off in the green, drifted down a little bit into the red, but no fireworks. Very similar story for the S&P 500. We'll get to sectors in a second. Just wanted to give you a visual picture of the VIX as well, which is now below 30, and then the ICE B of A Move Index, which is kind of like the VIX for the bond market. This is a 1 month chart, still hanging out near highs. So we still got some bond market volatility that we are dealing with. And then here's the sector action. Tech is in the first position there, up 1/3%. Financials up about 1/4%. So is communication services and real estate. Utilities just barely green. Energy a little bit negative. And then Staples finishes the day down the most, down 84 basis points. And let's flip over to the NASDAQ 100, where we see kind of a split screen. We have NVIDIA in the green, but for the most part, the mega caps in the red. Not Tesla, notably. Netflix up almost 5%, but not a lot of dark green here. Palantir also is catching my eye. That was up 6% today. That's an intraday chart of Palantir. And let's check out the Dow as well, where we see a lot more red than green here. So not as much tech exposure, which was the leading sector of the day. Aside from NVIDIA, we got American Express up 1%, Goldman Sachs up 0.8%. We've got those big bank earnings still rolling in today, although that should, I believe that's done today. So we'll just be focusing on regionals going forward. And I haven't looked at the transports in a while. So let's get a look at that. United Airlines, which is dropping earnings right about now. That's up 2%. Delta Airlines up 1%. American up almost 3%. And let's get a check on the banking sector one more time. JP Morgan down 0.7%. Everything else in this screen in the green. Barclays up 3%. Wells Fargo up 2%. Bank America up 3.5%. Finally, regional banks seeing a lot of green here as well. PNC in the upper left, the biggest one, just barely in the green, but USB up 1%, and Truist up 86 basis points. Back to you, Josh.
Thank you, Jared. For more on today's action, let's welcome in now John Velas, BNY Mellon FX and Global Macro Strategist, and so joined, of course, by Simeon Hyman, ProShares Global Investment Strategist as well. Welcome both of you guys to the show. John, I'll start with you. As Jared was saying, he described this as sort of a reprieve, I think he said, in the market today. And looking at, the broad gauge is down about 0.2%. 10-year held steady, John, at 4.33. I'm just looking at the dollar. It was firmer. The VIX is tumbled. What do you make of what you're seeing?
Pretty much a holding pattern today. We haven't had a lot of news. There was the news about the Chinese Boeing orders as we came in the morning, but that seemed to have been fully incorporated in the opening price. So really not much. What we're looking at is Treasury yields, and they've held in pretty well this time, and that's encouraging. So I think we're waiting for the next shoe to drop, and this is a headline-driven market, and today was sort of absent of headlines.
When you tell your clients, you try to gauge out what comes next, do you feel like you can say with any certainty what comes next? Oh
no, we're in the preparedness business, not the prediction business these days, and lots of things can happen sort of out of the blue, via tweet or via Truth Social post or via a quote or something that happens overnight in Asia. So what we're really looking at is Treasury yields staying in. We don't want to see them get unanchored and get away from them. And of course, one thing that probably was overlooked, but I referred to yesterday, the New York Fed 10-year inflation expectations didn't go up particularly very much, which is a contrast to what we saw in the University of Michigan data. And that's really important for the Fed. We've got Chair Powell tomorrow. Is he going to talk about the need to keep those expectations anchored and therefore kind of give a slightly hawkish tone to his remarks? And I think we'll all be waiting for 1:30 for that.
I know you're not in the prediction business, John, but I'm going to ask you to make a prediction. Okay. The 10-year, you see what ahead? Range bound, or what are you telling clients?
Yeah, we see it range bound. I mean, we still have a lot of fiscal issues to get through, and you talked about it earlier in the lead-in to the program, and I think that's one of the things that's on our mind. We have data that no one else has. We're the largest custodian in the world. We have $52 trillion of assets under custody. We can see every day the flows in and out of the Treasury market. And we've seen foreigners selling in the last 5 of the last 7 days, really since April 3rd, which was a big buy day after the Liberation Day was announced. There was a risk-off move in safe haven buying. We've seen foreign investors, cross-border investors selling out of Treasuries. So we're a little concerned that the yields won't go down further from here. And if we get continued and even accelerating cross-border selling, then we're worried that yields could go higher. But we're not really predicting that. We're just watching the data and taking a cue from that.
Simi, what do you think? 10-year range bound makes sense?
Yeah, I think we're almost getting back to a base case of a steepener. Because if we have a little bit more inflation from just sort of rational tariffs, but nothing too extreme, and the Fed comes in and they need to cut just to keep the economy humming along, in other words, not the bad case, but just a slightly bad case, that's where I think you could have a steepener, because you'll have maybe 50, 75 bips off of the overnight lending rate, but the 10-year could drift up towards 5%.
Drift up to 5%, John?
That's a big number. After the election, I thought 5% wasn't crazy. We got to 4.8 in mid-January. I don't know if we'll stay there. 5% would be troubling for a lot of leveraged assets. So we're hoping it doesn't get up that high, but it could drift higher, particularly if that foreign support that we've seen lacking in the last few days, if that continues to be a trend, is something we're watching.
I got to ask you about the dollar as well. What do you make of the moves we've seen in the greenback?
Yeah, much lower. I mean, I think the general view is when you put tariffs on a country, your currency goes up. That happened a little bit again in January, and really since sort of Liberation Day, that's not been the case. I think it's part of this foreign selling of U.S. dollar-based assets that I mentioned before. Around 100 for DXY, euro at 110, 112. That seems about reasonable given current conditions. The question is whether or not the Eurozone can remain unscathed from what looks to be a pretty intractable tariff battle. And if that's the case, you might see euro come off, but we're not there yet. We're still far away from that. We've got 90 days to go with or not quite 90 days to go with negotiations.
Simi, can I actually ask you, I had a number of strategists come on investors and tell me how excited they were about Europe. Does that enthusiasm, that optimism, does that sound reasonable to you? Do you find that, do you see opportunity over there?
Valuations are compelling, and I say that keeping in mind the following. When people say when Europe's 30% cheaper than the US, that's a deal, no, it's not, because roughly 30% cheaper than the US is the average long-term discount. But we're at 50 or 60. I don't think you have to go to emerging markets right now because there's too much commodity influence there, but certainly having your diversification include that developed market piece that you may have forgotten about is important. And the other thing that I'm encouraged by just watching the tape today, seeing small caps hold up. You know, small and mid caps particularly are 50 cents on the dollar to large caps. It's good to see valuation mean something. And also, think about mid caps, 75% of that revenue is domestic. So it's good to see almost a little bit of rationality coming back into the market.
All right, Simi and John, stay right there. Markets and businesses continue to look for clarity on the Trump administration's economic policies, ongoing tariff uncertainty making it a difficult task to get a pulse on the future health of the U.S. economy. Yahoo Finance's Brian Sozzi had the chance to sit down with U.S. Treasury Secretary Scott Bessent in Washington, D.C. to discuss on this and more.
Mr. Secretary, thank you for having us inside the Treasury. We appreciate it.
Thanks, Brian. Glad to have you here.
Yeah, no, this is
especially on April 15th.
Yes, tax day, of course. And of course, Mr. Secretary, we do sit here on tax day. Consumer confidence, it has been under pressure. Everybody loves to look at eggs, one of their favorite barometers. They're at record highs according to the CPI. The 10-year that has climbed to about 4.5%, has backed up a bit. And Mr. Secretary, I just had the CEO of Constellation Brands, they make Corona beer, telling me consumers are pulling back. Level set for us. What's the state of the economy through your eyes right now?
Well, Brian, let's back up a little. Egg prices, I believe, are down 50, 60, 70% off the highs. So that we inherited an egg inflation when President Trump came into office. I think egg prices were up 200-something% under the previous administration, and just through culling fewer hen houses and some imports, we were able to alleviate that. So, check. And consumer confidence, we're seeing some concern in the survey data, but we haven't seen anything in the hard data. So very, very solid job market last week, up 228,000 versus an expectation of about 150,000. And we have lots of CEOs come in, especially from financial institutions, since we're here at Treasury, and they're seeing solid credit card spending growth. They think the consumer's in good shape, corporate's in good shape. So in my prior life in the investment business, what we were not good at, and I think it's very hard to be very good at, is predicting the macroeconomic numbers. But what we did was form a mosaic. We called it the micro, so a bunch of micro data points drives the overall economy. And from right now, I see nothing alarming from the micro data points.
What do you say, you mentioned in your prior life, of course, you were a hedge fund manager, long career. We have Jamie Dimon out there saying a recession is likely. Just yesterday, Goldman Sachs CEO David Solomon said the prospect of a recession has increased. You know these leaders well. Mm-hmm. What do you say to these folks that are worried about a recession?
Look, I think that the news cycle, for whatever reason, is focused on tariff policy, and the Trump economic policy that I'm part of the team that's in charge of implementing it is really a three-legged stool. So tariffs are getting the majority of the publicity now, but we were having very good luck, or very, very good progress. It's not luck because it's been a lot of hard work on the tax bill. So the tax bill is moving through the Senate, moving through the House. I think we're going to have some permanence for the 2017 Tax Cuts and Jobs Act, probably by 4th of July. And I think that will give people certainty. And then the third leg is deregulation. So the tariffs came in quickly, taxes by midsummer, and then we think the deregulation, which could be substantial savings for households, will kick in third, fourth quarters.
Why do you think then the likes of Jamie Dimon and David Solomon, why would they be concerned?
Look, that's their job, is to be concerned. But again, I think that there is all this chatter on tariffs, and what we're worried about. And I come from Wall Street. I think Wall Street can continue to do great, but we are focused on Main Street. And my cousin who lives in coastal Georgia called me and said, congratulations, the gas here is $1.98. It's below $2 for the first time. So I think that we've got to look at it kind of on a holistic basis, everything that's going on. There's something called FCI, or Financial Conditions Index, and that's a combination of what's the stock market doing, what are interest rates doing, what's energy doing, what's the currency doing, and financial conditions, they are still in a very good spot.
Some experts I've talked to, Mr. Secretary, they acknowledge that gas prices have come down, but they, in the same breath, say that is because the economy has slowed. Where do you stand on that?
Well, look, everybody wants to have it both ways. That 2 weeks ago, there were all these stories, and as you know, Brian, that this year, I've tried not to talk about the stock market because the stock market is really a long-term proposition, and it's more fun that when it goes up in the short term, less when it goes down, but that people should be in it for the long term, and over the long term, it is the best asset for retail investors. But what I've been focused on is lowering energy prices and lowering the 10-year yield. So 2 weeks ago, 10-year yield hit 3.90, and I said, oh, well, Secretary Bessent's getting what he wanted, but for the wrong reason. Then it popped up last week to 4.50, and it's the end of the dollar, it's the end of the U.S. as a reserve currency, and in my mind, it was just a bunch of over-leveraged speculators who were getting stopped out.
So no foreign countries dumping treasuries?
We actually saw the opposite last week. We had 3 big auctions, and the 10 and 30-year auctions, which are when foreign buyers tend to come in, which is where they can buy in size. We actually saw very good foreign accumulation of 10-year and 30-year bonds.
Of course, as you know, Mr. Secretary, China is the second largest holder of treasuries, and some would say they could retaliate by selling treasuries given how things are going on the trade front. Does that keep you up at night, the fact that the Chinese could sell treasuries and impact negatively our economy?
I could burn down my house if I had an argument with my spouse, but it's not going to do me very much good. So that, if they started selling treasuries, they would, they'd have an effect on the price. But more importantly, they accumulate dollars. And what are they going to do with the dollars? So if they sell treasuries, then they would have to buy RMB, and it would strengthen their currency. And they've been doing just the opposite. They've had a weak RMB or yuan, the policy. So it really serves no purpose for them to weaponize treasuries.
If you saw them trying to weaponize treasuries, how does the Treasury Secretary respond?
Look, we have a big toolkit. We do buybacks. The Federal Reserve, I think if treasuries hit a certain level, or if the Federal Reserve believed that a foreign, I won't call them an adversary, but a foreign rival, were weaponizing the U.S. government bond market or attempting to destabilize it for political gain, I am sure that we would do something in conjunction with each other, but we just haven't seen that.
You mentioned tariffs. We're less than 90 days out from the tariff pause ending, Mr. Secretary. How many deals do you envision being done by the time that pause would lift?
Yeah, well, Brian, let's set aside China. There are 15 large trading partners. We set aside China, there are 14, and we're in rapid motion and setting up a process for the 14 largest trading partners, most of whom have very large deficits. So in 90 days, are we going to have a complete a formal legal document done and dusted? Not likely, but I think if we follow the process, we could have substantial clarity on those 14 away from China in terms of agreements in principle. And then once we reach a level that we've agreed on and they've agreed to lower their tariffs, lower their non-tariff barriers, currency manipulation, and subsidies of industry and labor, then I think we can move forward.
Would tariffs still be in place, though, as part of any agreement?
Depend on what they have on offer. I'm telling everyone, bring your A game. And also, they should all know, for the big countries, President Trump wants to be involved.
What does a first mover get?
Well, traditionally, first mover gets the best deal. So I'd encourage everyone to come fast and come with a great deal.
Have you talked to your counterpart in China?
We did an introductory call a couple of months ago. We haven't spoken since. I'm not sure who from PRC will be. Next week is a big week in Washington. It's the International Monetary Fund World Bank Week. So I know that People's Republic will send someone from finance, probably the PBOC, People's Bank of China governor. So they will be here. I may bump into them. We don't have anything scheduled.
How much is the president willing to go beyond 145% tariffs on China, or is that the ceiling?
Look, I think no one thinks that these are sustainable over the long run. But with President Trump, I'm not going to give away his negotiating strategy on a widely viewed network like Yahoo. So I think, as with President Trump, he gets maximum strategy because he keeps everything on the table all the time.
What I imagine can't help, Mr. Secretary, is that on his trip to Vietnam, China President Xi Jinping said tariffs, quote, are unilateral bullying. I mean, I can't imagine that helps this process at all.
Look, also, I think the the Chinese trade minister said the tariffs were a joke. And I don't know, maybe Chinese have a different sense of humor than I do, but I don't think there's anything funny about it. But I also don't think there's anything funny about the intellectual property theft that they've done, the blockage that we've had on reciprocal trade with them, the tariffs that they put on, the subsidies that they do for labor, for industry. So I don't see anything funny about it.
What's the best endgame scenario for the relationship with the U.S. and China in terms of tariffs?
Well, Brian, for your viewers, and I used to teach economic history, so if you just give me a moment or two. There were a lot of big trade and currency deals in the 1980s. President Reagan did Japan auto deals. Then there was something called the Plaza Accord, the Louvre Accord, and what was important and different about those was in the 80s, our economic rivals were our military allies. So most of the Europeans and the Japanese, and that there was the Soviet Union, and then China, but China really wasn't a force back then. What's very different this time, and we are in uncharted waters here, is for the first time, our largest economic rival is also a military rival. So we are going to have to deal with this in a different way. Now, I think that the Chinese, I think they would acknowledge, but they've been reluctant to do it. And every macroeconomist who follows China, who I know, believes that the Chinese need to do a big rebalancing. They are the most unbalanced economy in the history of the modern world, and they favor production and manufacturing over consumer. And relative to their share of world population, relative to their share of GDP, they export more than any other country ever has. So the first contour of a deal would be for them to take steps to increase consumption, help households, and stop the subsidy to the manufacturing sector. And so, a good deal would look like they rebalance toward more consumption, less state subsidized manufacturing. In the US, we have a bit less consumption, and we bring back a manufacturing base, and that could work very well together in a symmetric way. But we haven't seen any interest on their side to do that.
Sounds like a lot needs to be done, Mr. Secretary, to reach a deal with China.
Look, these are two big economies. I think the good news at the end of the day is that President Trump, Chairman Xi have a lot of respect for each other. They've been in contact before, and they've done deals together.
The market has gotten excited because certain electronics will be excluded from tariffs. That exclusion, did that come about after a conversation with Apple CEO Tim Cook?
I wasn't on the exclusion.
Now, Apple has said, specifically Tim, that it's hard to make products in the U.S. I believe it was a 2015 interview, in part because the skills aren't here to make these iPhones and make them profitably. New report out of Woodbush Securities, Mr. Secretary, suggests if an iPhone is built in the U.S., it costs $3,500. Would that be acceptable to the administration?
Look, I haven't seen any of that, and I know Apple's been moving quite a bit of their supply chain into India, and I also think, look, you don't need a PhD in mechanical engineering to assemble an iPhone, so I'm not sure why Tim Cook says that the skills aren't here.
But the prices to make it would still cost more, and and Apple would have to trade. It's not, they can't open a factory overnight.
Of course not. Of course not. So over time, they'll move their supply chains, and they've been moving out of China for a long time. We've seen a lot of manufacturing move to Vietnam, move to India.
How important was it to get news that NVIDIA is going to spend $500 billion here to make AI supercomputers?
NVIDIA, I believe, has 98%, which is incredible, of the upper end chip market. And I think that for NVIDIA to bring this home is very important. And one of the greatest security concerns for global economy is the number of chips made on the island of Taiwan. To have one of the most important components made in one place is not great risk management. But you could say that about anything. Like you wouldn't want anything, wouldn't want to source just one thing from one place, especially when the whole world runs on it. I mean, imagine that if Abu Dhabi were the only place in the world that pumped oil. Right? It's the equivalent of that.
I talked to a lot of CEOs, Mr. Secretary, especially over the past 2 months, and these are their words, not mine. They have told me their businesses have started to fall into chaos. They can't plan for the next 5 to 10 years. They are now considering cutting back on marketing and how many people they're hiring. What's your message to these very large CEOs? They hold the economic purse strings in many respects that are having difficulty understanding what the administration is doing.
Well, again, as I said, I think we're going to have a lot more clarity on tariffs. And I assume the reason you're asking me the question is because they have that view on tariffs, but we're going to have a lot more clarity on the way forward over the next 90 days. And then they'll also have clarity on tax and, excuse me, on deregulation. I remember in 2017, I heard a lot of the same things because the tax deal wasn't done until right before Christmas in 2017. And it was the same thing. We can't plan, we can't do this, we need clarity. So we're going to have clarity on tax, we're going to have clarity on deregulation. And I think over the next 90 days, it won't be finished, but we will have much more clarity on tariff policy.
You're also working very hard on taxes and President Trump's economic agenda and, as it pertains to the tax plan. How will the tax plan help someone making less than $100,000 a year?
Well, I think it depends on what they do, but or their age. But if you think about no tax on tips, no tax on Social Security, no tax on overtime, we're going to go back to deductibility of auto loans if it's an American car, which when I bought my first car in the 80s, you were able to deduct auto loans. So people could take advantage of that. I think we will also see the surety of this staying in place, because what really fueled a lot of the economic growth during President Trump's first term was the full expensing of equipment by corporates. We're planning on full expensing of new factories also. So that's how we want to bring back manufacturing. You can write off the cost of your factory and the cost of your equipment in 1 year. And during President Trump's first term, because of these economic incentives and the private sector hiring, as opposed to what we saw from the previous administration, that we saw the real wage growth. And it was very substantial. It was higher for hourly workers and supervisory workers. We saw the bottom 50% of households, the net worth increase faster than the top 10%. So I think we could expect that again.
Are you okay with letting tax breaks on the wealthy expire?
I think that we're looking at everything. So we're looking at a range of revenue raisers. And I'm not going to get out ahead of the president, which is always a bad idea. And we'll see where the president comes down on that.
Lastly, Mr. Secretary, I know financial literacy is near and dear to your heart. And I think a lot of Americans have a lot of stuff coming at them, whether it's stock prices, stock price volatility, movements in the bond market. How can they go about becoming better investors?
Well, I think the more you read, the more you're informed. But I think the most important thing, what I've noticed, is that there's a whole range of financial advisors now, and who are willing to educate you, very, very reputable from some of the biggest firms. But I think the most important thing that households can do in terms of financial literacy is understand your goals and understand the products that you're invested in, and kind of do a gut check and rate your personal risk tolerance. And obviously, a young person should have higher risk tolerance and a longer horizon. If you're getting closer to retirement, then your risk tolerance should be lower. But again, too, that there are no get-rich-quick schemes.
If someone was studying your career, I mean, how could they replicate what you did? I mean, you broke the Bank of England, Mr. Secretary.
Well, I also, a lot of it's timing. That I was a college freshman in 1980. Ronald Reagan was elected. The Capitol got treated very well for the next 4 decades. So we've had this incredible run. But again, to the extent I had a strength in my business, it was always risk management. You're always thinking, what amount of risk am I willing to take? What amount of risk are my investors willing to take? And you always want to be on your front foot. You always want to understand everything you're doing. You want to think about one big component of financial literacy is the household debt level. What amount are you able to save for a rainy day fund? But again, it all comes back to what are your goals? What amount of liquidity do you want? What are your personal circumstances?
Mr. Secretary, thank you for having us here inside Treasury. We really appreciate the time, and good luck on your work. It's very important.
Good. Thank you.
Thank you so much. Thank
Good
you.
to see you.
Thank you.
Well, here now with the key remarks from Treasury Secretary Scott Bessent, and we have Yahoo Finance's executive editor, Brian Sazi. Brian, a great interview, great conversation. You covered a ton of ground there. I'm curious to hear what your top takeaways were.
Josh, thanks so much, man. I really appreciate that. A couple takeaways for me. One, noting that tariffs with China at 145%, I believe the Secretary said, not sustainable in the long run. So a little hope there, perhaps, to those that have been buying the dip in stocks this week. Did acknowledge, though, that a significant amount of deals may not be done in that 90-day time frame. There is likely to be deals done, but maybe not 130 plus deals across the board with many major countries. I also found it interesting, Josh, the Secretary calling out a level of hopefulness on the tax plan potentially coming to a stronger light by July 4th. I thought that was very interesting. Could be a potential catalyst for the broader market. But again, all eyes, Josh, as you know, on all things tariffs, what may or may not happen to them. I will say this. Sitting across from the Treasury Secretary, did get a sense that the sides remain far apart in terms of the U.S. and China are reaching any form of deal on tariffs. I guess the positive here would be that there doesn't appear to be another escalation in the cards, but of course we'll be watching, waiting, and maybe seeing.
Brian, again, terrific interview, my friend. Thank you so much for bringing it to us. Appreciate it. Well, for more reaction to the comments from United States Secretary of the Treasury Scott Bessent, let's bring back in now. We've got John Vellis, foreign exchange and global macro strategist at BNY Mellon. Of course, Simeon Hyman here with us as well. John, start with you. You were listening right alongside. What were your standouts to you, John? What stood out to you?
They've got a plan. I mean, they certainly have an aggressive and well-stepped plan. I think the sequencing was a bit unfortunate with the tariffs first and the Treasury, the fiscal plan later, and that's created more uncertainty, and that'll persist until something gets done on the fiscal plan. And I think that's the big, once the tariff clarity, if we get there, it'll be unclear for a while. Maybe that 90 days is the expiration date of lack of clarity, and we'll get some idea how far we'll go, what deals are made, and what are the aspects. The fiscal plan is going to be more difficult, and that's the next thing we're going to be watching very, very carefully and almost on a headline basis as well. It's going to be expensive. We'll see how they can fill some of those gaps.
Simeon, how about you? What were the standouts?
That fiscal piece is important. I mean, one thing we learned is that the administration is looking at that bond market. They are willing to let the equity markets go a little bit, but the bond vigilantes scared them. And I don't think it's any coincidence that we now see this possibility of a tax hike for the highest earners in this country, You wouldn't have heard that until the bond vigilante showed up.
Yeah, good points. I mean, John, thank you so much for joining us. We appreciate it.
Thank you.
All right, shares of United Airlines are rising as the company tops first quarter earnings expectations, provides insights into guidance amid macroeconomic uncertainty. Third Bridge Global Head of Sector Analysts Peter McNally joins us now with a closer look at first quarter results for United Airlines. Peter, it is great to have you on the show. I'm just looking, this stock is ripping here in the after hours, Peter. It's up about 6.5%, but let me get your take, your response to the report and the results, Peter.
Well, I think there's a couple things to keep in mind here is, number one, expectations were set pretty low at this point. Estimates have been coming down for a month, started by Delta's pre-announcement in the middle of March. But the second thing is that, United sort of put a stake in the ground here in a recession scenario. Their earnings estimates will be $7 to $9 a share. So, and that would be with a 5% decline in revenue. And they're not sitting back. They're cutting 4% of capacity starting at mid-year, adding on to what they've already done as we've seen a slowdown in demand for air travel. And so the big picture is it's still a pretty profitable airline, despite some of the headwinds that have merged here in the first 3.5 months of the year.
Peter, Simeon Hyman, is that fair to extrapolate that to the sector? You think of airlines as quite cyclical and not being able to do that well in a recession. So they're saying it won't be that bad. Can we extrapolate it?
I would not, Simeon. Look, the one thing about United is that they've always been investing for growth. And so they're taking even more planes that are more efficient and allow for more premium seating, and that's where the money is made. And then the real distinguishing factor for Delta, United, and to a lesser extent American, is their loyalty programs that have been a great competitive advantage, and that's going to add to earnings. These smaller regional airlines and the low-cost carriers are finding it more difficult to compete because they got smaller fleets, okay, and they're dependent also on Boeing delivering new planes or and some more competitive routes. And it's more difficult for them. So I think United's a standout. They've been investing aggressively for years, like in this fleet, and at times it's made people nervous. But at the end of the day, it's always worked out for them. So that's why I don't think I would extrapolate this to the rest of the industry just yet.
Peter, fuel costs have been coming down here. What does that mean for United and the broader sector?
I mean, it has certainly helped. But the one thing about it is that it helps all the airlines equally. Nobody really has an advantage when it comes to that. I mean, Delta to a small degree in that they own a small refinery outside Philadelphia, but it doesn't offset the hedges or create that much of a hedge for them. It's just certainly allowing a cushion as revenues fall or revenue expectations fall with this demand weakness we've been seeing lately.
Has there been a change in the hedging protocol? Because we used to get surprised back in the day. The oil prices would come down, and then these guys would come out and say, well, we locked in for the next 18 months, so it doesn't make a darn bit of difference. Has that changed in the last 10 years or so?
I mean, there's been less of it. I mean, look, oil's been fairly volatile in recent years, and you're buying insurance, right? And that insurance has gotten more expensive. The more levered companies, with weaker balance sheets have been forced at times to lock in those prices. But the Deltas and the Uniteds of the world, it's not making that much of a difference.
Peter, the earnings calls tomorrow morning. If you had the chance, ask the CEO a question or two, what would be top of mind for you?
The slight changes in the CapEx plan. They've dialed it down a bit. This is the second year in a row where they've walked it back. So what actually gets United to go all out for the 2026 plan that they've had what they need to see in order to push ahead with those investments to invest in the new aircraft?
Final question, Pete. I want to switch gears here a bit because this company as well, Boeing. Bloomberg did report China has ordered its airlines, Peter, not to take any further deliveries of Boeing jets. It sounds like what we have here is just this tit for tat in the trade war, Peter. I'm just curious what you made of that headline. What did you make that news? What did it mean for Boeing investors?
Boeing has 130 planes on order with China of the 6,400 in total in their unfilled backlog. It's not that big of a deal on that news, just itself. And it's not like China can go anywhere else. It's, Airbus doesn't have a whole bunch of planes sitting waiting either, but I think it's just kind of more noise when it comes to Boeing financially than anything else.
All right, we're going to leave it there. Peter, as always, thank you for that instant analysis and insight, my friend. We appreciate it.
Good to see you.
That's going to do it for today's Market Domination Overtime, but don't go anywhere. On the other side of break, it's Asking for a Trend. We've got you covered with the latest and greatest market moving stories, so stay tuned.